In this module, I'm going to share how a low-income earner might apply the 30% investment tax credit to their unique situation. Let's say we have a homeowner that's earning $40,000 a year in income, and they get a standard deduction, and they get their taxable income, and that would allow them to pay about $4,000 in income taxes. $4,000 in income taxes they owe. Now, let's say they were to buy a $50,000 solar system. So 30% tax credit on $50,000 is a $15,000 tax credit at the IRS, but they only paid $4,000 in income taxes. What happens in this scenario? Well, remember, you can't get money out that you didn't pay to the IRS. It's a non-refundable tax credit. So in this case scenario, the homeowner paid $4,000 in taxes, and they're going to get a $4,000 tax credit refunded back to them. Now, they had $15,000 minus the $4,000, so they have $11,000 of tax credit sitting at the IRS for next year. And they actually have 22 years to use up that $11,000. So they might, if they're paying the same amount of income each year, they're earning the same amount of income each year, it would take them about 3-4 years to get all that money back from the IRS. Make sense? Okay, great.